The Brex Corporate Card represents a significant shift in how modern businesses handle their finances, specifically targeting high growth startups and mid market companies that often find themselves underserved by traditional banking institutions. One of the most important things to understand right out of the gate is that this is not your typical credit card. It is a corporate liability card, which means it evaluates the health of the business rather than the personal credit score of the owner. For anyone who has spent years building their personal credit and doesn't want to risk it on a business venture, this is a massive relief. The underwriting process is based on the company's cash balance, revenue, and investor backing, which allows for a much more realistic assessment of what a company can actually afford to spend. This approach translates into dynamic credit limits that are typically 10 to 20 times higher than what traditional bank cards offer. There is zero annual fee associated with the card, which is always a plus for companies looking to keep overhead low. However, it is vital to note that there is no APR or annual percentage rate because this is a charge card, not a revolving credit card. This means the balance must be paid in full, either monthly or daily, depending on the specific account setup. There is no option to carry a balance from month to month. If a business needs to finance inventory over a 6-month period, this tool simply won't work for that specific pain point. But for those who have the cash flow and want to maximize their spending power, the benefits are substantial. From an operational standpoint, Brex acts as a spend management ecosystem. It aims to replace both the physical credit card and the cumbersome expense reporting software like Expensify or Concur. The automated expense management features are a lifesaver for finance teams. Employees are prompted to snap a photo of receipts, and the system uses artificial intelligence to match those images to transactions automatically. This can save dozens of hours during month-end closing, allowing the team to focus on growth rather than paperwork. For companies with a global reach, the ability to issue physical or virtual cards to team members instantly around the world without any foreign transaction fees is a game changer. The rewards program is aggressively tailored for the modern tech-focused business. The multipliers are quite impressive: 7 times points on ride shares like Uber and Lyft, 4 times on Brex Travel, which covers flights and hotels, and 3 times on restaurants. Additionally, companies get 2 times points on recurring software or SaaS subscriptions and 1 point per dollar on everything else. There's also a Brex Perks package that offers new users access to over $350,000 in discounts on essential tools like AWS credits, Slack, and QuickBooks. To get the best multipliers, which they call Brex exclusive, companies are often required to use Brex business accounts as their primary operating account. This creates a bit of a walled garden, but for many, the trade-off is worth the streamlined experience. However, the card is not for everyone. The eligibility requirements are quite restrictive. Generally, a company needs a large cash balance, such as $50,000 or more for venture-backed startups, or high monthly revenue around $400,000 for mid-market companies. This means sole proprietors and very small mom-and-pop businesses will likely be rejected. Furthermore, because it is a charge card, the inability to carry debt is a significant drawback for businesses that rely on revolving credit to manage cash flow. Customer support for smaller accounts can also be a bit of a hurdle, as these users often rely on chat and email support, which can feel slower than the dedicated representatives provided to enterprise clients. In summary, the Brex Corporate Card is an exceptional tool for venture-backed startups and fast-scaling companies that value automation and high spending limits. It removes the personal risk to the owner's credit and offers best-in-class rewards and software integration. However, the risks and limitations are clear. If the company bank balance frequently dips below $25,000, or if the business model requires carrying a balance to bridge cash flow gaps, this card is not the right fit. The strict eligibility requirements and the necessity of paying the balance in full every cycle make it a specialized tool for a specific type of high-growth entity.